Yeah, so that marks a cyclical peak, absolutely, sometime in 2020, as you said. We have an undersupplied global oil market right now to the tune of 1 million barrels a day. So global inventories in the course of 2019 are poised to shrink by over 300 million barrels. That alone is a lot. Now, in 2020, U.S. production growth, we've been watching this closely, is likely to slow by half because the drilling activity has been declining in recent months, and that will feed into 2020.
Declining why? Because the demand isn't there, or because the price is too low to bring it out?
The price is too low to bring it out, and companies, E&P companies, are responding to shareholder pressure for more capital discipline, which means less rigs running, instead more dividends, more share buyback. That's bullish for supply. The other thing that happens in 2020 is IMO. This is the low sulfur fuel regulation taking effect in January. That we think will wipe out about 1 million barrels of high sulfur supply that will be rendered effectively unusable. So, who's going to fill that gap? Well, Saudi will have to pump all out. But even with that, we think inventories are likely to continue to shrink over the next 12 months.
All right, let's get to a couple of the stocks that you like and one you really don't like. And the one you really don't like is ExxonMobil, because you just don't see it benefiting from the cyclical highs that you see occurring next year. But let's go to the ones you do like: Oxy, Marathon, and Cosmos. Why?
These are three essentially pure oil producers, about as close to 100% crude oil exposure as you can get among U.S.-based companies. If you believe, maybe not $100 oil, 80 would be just fine for 2020. If you believe in significant 30-40% upside in crude from current levels, you want the most operating leverage. Exxon, by contrast, is a highly integrated company. It is the third largest chemical company in the world, and at a time when, by the way, the chemical industry is in a down cycle. Exxon's chemical earnings were at the lowest level in 11 years. Oil prices go up. That's a headwind for the chemical operations. Sure, Exxon will make more money on, overall, but the pure oil producers like Oxy, which of course is about to close the Anadarko acquisition, will do much better on a relative basis because they have such a tightly focused asset base.